Scroll through any finance forum long enough and you'll find them. The comment that shows up every single time someone mentions dividend investing: dividends aren't free money. The stock price just drops by the same amount. You're not gaining anything. If you've built a portfolio around dividend-paying shares, that comment probably makes your blood boil a little. It feels dismissive. It feels like someone's mocking a strategy you've spent years building, using a piece of math they think you've never considered. Here's the uncomfortable part. They're not wrong. Not about math anyway. A stock's price genuinely does drop when it pays a dividend by roughly the exact value of that payout. That's not internet folklore. It's how markets mechanically work. So if the critics have the numbers right, does that mean dividend investing really is a mistake? Are Australians who build their retirement around fully franked shares just fooling themselves? Stick with this one, because the honest answer is far more interesting than either side of that argument wants to admit. Let's do something most dividend content never does. Let's concede the point immediately, fully, and without spin. When a company pays a dividend, it's distributing cash that already belonged to the business, cash that was sitting on the balance sheet, backing the value of every share. The moment that company pays it out, on what's called the ex-dividend date, the share price adjusts downwards to reflect the fact that the cash is no longer inside the business. If a company was trading at $50 and pays a $1 dividend, all else being equal, it opens the next morning at roughly $49. That's not a glitch, and it's not a coincidence. It's basic accounting. The company is worth what it holds: cash, assets, future earning power, and when cash leaves, value leads with it. There's no magic wealth creation machine hiding inside a dividend payment. You haven't been handed anything the company didn't already own on your behalf. So the illusion of free money genuinely is an illusion. But here's where the internet critics stop their analysis, right at the exact moment things get interesting. Because conceding that dividends aren't magic doesn't answer the far more important question: what was the alternative? If that cash hadn't been paid to you, what would the company have done with it instead? That single question is where this entire debate actually lives. To really understand what's happening on that ex-dividend date, it helps to step outside the stock market entirely and imagine owning a small local business instead. A car wash, a cafe, a laundromat, whatever you like. Suppose the business generates a healthy profit each year, and at the end of the year, you and your business partners decide to pull $50,000 out as a cash distribution, leaving the rest inside to keep the business running. The business is now worth $50,000 less than it was the day before, purely because that cash physically left the account. Nobody would seriously argue you'd gained nothing. You gained $50,000 in your pocket, while the business correctly is valued at $50,000 less than it was holding the day before. That's precisely what happens on a stock's ex-dividend date. The share price reflects the business minus the cash it just paid out. But, and this is the part that matters, the earning power of that business, its customer base, its brand, its ability to generate next year's profit hasn't been touched at all. The price adjustment is a bookkeeping reality, not a wound to the underlying company. This is the critical difference between a short-term price adjustment and a genuine, permanent loss of capital. If a company's share price fell because its earnings collapsed, that's real damage. A business that's actually worth less than it used to be. But a price dip caused purely by a scheduled dividend payment is temporary accounting, not deteriorating fundamentals. The business earns its way back to that value over the following weeks and months, assuming nothing else changes. Understanding that distinction quietly dismantles most of the dividends are pointless argument. But it opens up a much bigger question that the critics rarely engage with, honestly. Cash doesn't just vanish once it leaves a company's balance sheet. It goes somewhere, and where it goes tells you almost everything about whether that company deserves your trust. If a company decides not to pay that cash out as a dividend, it has to do something else with it. And one of the most popular alternatives, especially among large listed companies, is the share buyback, using company cash to repurchase and retire its own shares. In theory, this can be a perfectly smart use of capital. Buying back shares when they're genuinely undervalued concentrates ownership among remaining shareholders and can be more tax efficient in certain circumstances than a cash dividend. That's the pitch, and it's not fictional. It can absolutely work. But here's what critics of dividend investing conveniently leave out of the conversation. Company management doesn't always buy back shares because they're cheap. Far too often, buybacks accelerate exactly when a company's share price is at its most expensive. During boom years, when management is flushed with confidence and cash, and everyone assumes the good times will keep rolling. Corporate history is full of examples where companies aggressively repurchase their own stock near a market peak, only to watch that same stock lose a significant chunk of its value in the following downturn. That's not returning value to shareholders. That's destroying it, using the shareholders' own money at exactly the wrong moment. A cash dividend doesn't carry that same risk of mistimed judgment. There's no decision being made about whether now is a good time to buy shares back. The cash simply leaves the business and lands directly in the shareholders' hands, where they, not a corporate finance department guessing at valuations, get to decide what happens with it next. Dividends replace a speculative bet on management's stock-picking instincts with the simple, boring, reliable transfer of value. None of this means every buyback is bad or every dividend is good. It means that the accountability built into a regular, visible dividend payment is a genuine structural advantage, one the dividends are inefficient crowd rarely gives proper credit to. There's a companion argument that usually follows close behind the buyback debate, and it sounds intellectually serious on the surface. Mature, profitable companies shouldn't pay dividends at all. They should reinvest every available dollar back into the business, because reinvested capital compounds faster than a cash payout ever could. It's a compelling theory. It's also, quite often, wrong in practice. The uncomfortable truth about large, mature businesses is that they eventually run out of genuinely high return ways to reinvest their own profits. A company generating billions in annual cash flow can only open so many new stores, build so many new factories, or launch so many new product lines before the returns on each additional dollar of investment start shrinking. When management is under pressure to grow and has more cash than good ideas, that combination has historically led to some spectacularly wasteful decisions. Ill-fitting acquisitions bought at inflated prices, ambitious side ventures that quietly bleed money for years, expansion into markets the company never understood. Paying a dividend forces discipline onto a management team. It says, in effect, if you can't find a genuinely excellent use for this cash, give it back to the people who actually own the company and let them decide where it goes next. Some of the most consistently reliable long-term compounders in the market, established consumer brands, essential infrastructure businesses, well-run banks, have built enormous long-term shareholder value precisely while paying steady, growing dividends the entire time. Growth and income were never actually opposites. That's a false choice the loudest voices on both sides of this argument like to pretend is real. But even once you accept all of that dividends aren't pointless and that reinvesting everything isn't automatically superior, there's still one more piece of internet advice left standing, and it might be the most dangerous one of all. It sounds so simple when someone types it out in a forum reply. Don't worry about dividends at all. Just sell about 4% of your portfolio every year, and you've created your own income stream, one that's arguably more tax efficient too. On a spreadsheet, that argument holds up beautifully. In real life, during an actual market crash, it can quietly fall apart. Imagine you're retired, relying on your portfolio for living expenses, and the market drops 30 or 40% over a matter of months, which has happened repeatedly throughout market history and will happen again. Under the just sell share strategy, you now have to sell a chunk of your portfolio at severely depressed prices just to cover this month's groceries and bills. Every share you sell during that downturn locks in a permanent loss on that portion of your capital and gives it no chance to recover when the market eventually rebounds. This is sometimes called sequence of returns risk, and it has quietly devastated retirement plans that looked perfectly sound on paper. There's also the psychological weight of it. Deciding what to sell and when during a crash requires a level of cold, calculated composure that even experienced professional investors struggle to maintain, let alone someone trying to enjoy their retirement. Add in the practical friction of triggering capital gains, choosing which specific shares to sell, and repeating that stressful decision every single time cash is needed. And just sell 4% starts to look a lot less simple than it did in a forum comment. A dividend-paying portfolio sidesteps almost all of that. The cash arrives automatically without requiring you to sell a single share, without forcing a decision during exactly the moment your judgment is most likely to be clouded by fear. You're not choosing what to sell during a market crash because you don't have to sell anything at all. That's not a mathematical advantage. It's a behavioral one, and behavior is where most retirement plans actually succeed or fail. Let's zoom out from company-level decisions and behavioral psychology and look honestly at the bigger picture. How have dividend-focused portfolios actually performed against growth-heavy portfolios over long stretches of market history? The honest answer is that it depends enormously on the economic backdrop, and pretending otherwise would be dishonest. During the era of historically low interest rates that followed the 2008 financial crisis, capital was cheap, borrowing was easy, and investors were willing to pay enormous prices for companies promising future growth, even while those companies paid little or no dividend at all. In that specific environment, growth-oriented portfolios often outpaced steady dividend payers by a wide margin. Anyone who lived through that period and only compared the two strategies during those years would reasonably conclude dividends were the inferior choice. But stretch the timeline further across multiple decades and multiple different interest rate regimes, including periods of higher rates, tighter credit, and more cautious markets, and the picture becomes far more balanced. Divide and focus strategies have held their own across a wide range of economic conditions, often providing more stable total returns during periods when growth stocks were being repriced sharply downward. The real lesson here isn't that one approach permanently beats the other. It's that judging an entire investment philosophy based on one favorable decade for the opposing side is exactly the kind of shallow analysis this whole debate deserves better than. There's a final piece of this puzzle that rarely shows up in spreadsheets at all, and it might be the most important one of everything we've covered. Picture holding a portfolio of high-flying growth stocks through a brutal market downturn, the kind where individual holdings can fall 50% or more in a matter of months. Every time you check your account, the number staring back at you is smaller than the day before. There's no cash arriving to soften that blow, no tangible proof that anything is still working, just a falling number and a growing temptation to sell everything and walk away, right at the worst possible moment to do so. Now picture holding a portfolio of steady dividend payers through that exact same downturn. The share prices are falling too. Nobody's fully immune to a market-wide crash. But every quarter, cash still lands in your account, real, tangible proof that the businesses you own are still generating profit, still functioning, still paying their owners, even while the headlines scream about collapse. That regular cash flow acts as a psychological anchor, something concrete to hold on to when everything else feels uncertain. This matters more than almost any statistic in this entire discussion, because the single biggest threat to most long-term investors isn't picking the wrong strategy. It's abandoning a perfectly reasonable strategy at exactly the wrong moment, out of fear. A dividend stream doesn't just pay your bills, it keeps you calm enough to stay invested when staying invested is the single hardest and most important thing to do. So, back to where we started. The internet critics are right that dividends aren't free money, and the price adjustment on the ex-dividend date is real, mechanical, and undeniable. But being right about one narrow mathematical detail doesn't make someone right about the entire strategy, because the alternative uses of that cash come with their own very real risks, and the psychological value of steady income turns out to matter just as much as the numbers on a spreadsheet. The strongest position here was never dividends versus growth in the first place. It's building a portfolio that uses both growth-oriented holdings to compound wealth over the decades, paired with reliable dividend payers to provide cash flow stability and the emotional discipline to stay invested when markets get rough. That combination doesn't try to win an internet argument. It tries to actually work for decades through every kind of market the future has in store. So here's the real question worth asking yourself. Are you building your portfolio to win a debate or to survive the next crash with your plan and your composure fully intact? Let us know where you land in the comments and whether your own portfolio leans toward growth, income, or somewhere sensibly in between.